Question 29 is a ROCE calculation question, but here picking up on the complexities where we have an investment in an associate, such that within our statement of profit or loss we will be including a share of profit from that associate. The important thing here is that it's fine to calculate return on capital employed either including or excluding that associate as long as we're consistent in both parts. So if we're going to include the profits from the associate, we need to include the fact that that is part of our assets, whereas if we're going to exclude that profit, we need to strip out that asset as well. So here we've been given the return on capital employed that's already been calculated for company B and asked to calculate a comparable return on capital employed for company A. So we need to work out how they've actually arrived at this 28.7% so that we can be comparable for company A. If we look at company B's figures then, if we were to include the effect of the associate, the figure that we would be looking for as our income line would be the profit before interest and tax. So I need to calculate backwards from this 509 here, add back on the finance costs, which would give me a figure of 541. I could therefore go and calculate return on capital employed by taking that 541 divided by the sum of the capital employed here of 2150, but unfortunately this gives me a figure of 25.16%. This isn't how they happen to have calculated it in this case. Instead, if I want to exclude the effect of the associate, I need to go one stage further here to calculate what the profit would have been excluding the profit from the associate, which in this case would have been a figure of 516. However, now when I come to calculate the capital employed, instead of using that 2150, I need to strip out the value of the investment in the associate as well, so that the top and bottom part of the fraction is comparable. If we do that, we should find that the return on capital employed for company B is the 28.7% as given in the question. So now we know that in this case we're calculating return on capital employed excluding the effect of the associate. So for company A, I want to do the same, and starting with this profit figure of 680, I need to go and strip out the finance costs and the share of profit from the associate. If we do that, we should end up with a profit figure of 557. In order to calculate the return on capital employed then, we will take that 557 and divide it by the sum of the capital employed here of 1450 less the investment in the associate of 570, and in doing that we would calculate a return on capital employed of 63.3%.